Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. It feels like summer's winding down. I don't know what happened. I feel like as a kid, summers were like 3-4 months, and now they feel like they're like 2. Anyway, beautiful time here in SoCal. We got a great episode today. Our guest is Mark Higgins. Mark is a senior VP at IFA Institutional, where he specializes in advisory services to institutional plans like endowments, foundations, pension plans, the big money, the real money. He's also the author of Investing in U.S. Financial History, this big doorstop here. You guys know I love it just from the title. Understanding the Past to Forecast the Future. It's one of my favorite books on financial history. And more importantly, he's a fellow Wahoo, another UVA alum on the podcast. Mark, welcome to the show.
Thank you for having me, Meb.
Where do we find you today?
I am in Portland, Oregon, which is where I live. I'm in the basement where behind me is just a small sample of the note cards that I wallpapered my wall with to track all of the important events, quotes, things like that from about 230 years of financial history. So I often thought I was crazy. People may think I'm crazy, but that's the only way I could do it.
Very old school, very analog of you. This is a great book. I read this. When did this come out?
It came out end of February 2024.
Okay. So post-COVID, you had some time to write this in your basement. Massive endeavor. Listeners, this is like a 500-pager. It's well worth it. It's super interesting. You mentioned the quotes. I got about a dozen here bookmarked, so we'll go through them today. But it's fun because there's so many parallels to today. And I thought we'd start with, like, at the very beginning of the book. This feels so timely to me. You're talking about the Panic of 1792, but you're talking about a particular fella, and by the name of William Duer, I think, and Alexander Hamilton appointed him the Assistant Secretary of the Treasury. You want to tell us a little bit about this rascal, and we can kind of talk about why this parallels today so much?
Yeah, so the call out is, I think I called him the founding father of insider trading. And so he was an assistant Treasury Secretary to Alexander Hamilton, and he knew that Hamilton was going to do financial programs that would actually bring the debt of the United States back up to par. They were essentially in default. All the states and the federal government was in default. So he had that insider information. Him and a couple of his friends went around the country buying these bonds for pennies on the dollar, knowing that they were eventually going to go to par in a year or two, and he made a killing. But then the part that you're probably referring to is he tried another gambit by cornering the 2 bank stocks in 1792, and it failed. It turned into a major financial panic, and a lot of innocent people and people that participated in the frenzy when he tried to corner these 2 bank stocks were ruined in the crash. And that actually prompted the formation of the Buttonwood Agreement, which was really the seeds of the New York Stock Exchange. And it's an interesting story. I'm actually going to be publishing an article in the Wall Street Journal in a couple of weeks on just the history of the New York Stock Exchange and Wall Street. And that is really the opening story.
Very cool. Well, I'm going to read this long quote from Carnegie that was at the top of this little sidebar. It says, "The public debt affords the best field in the world of speculation, but is a field in which strangers may easily be lost. I know no way of making safe speculations, but by being associated with people who form their official situation, know all the present, and can aid future arrangements either for or against the funds." You know, I mean, we're in this crazy time today where insider trading laws are pretty specific, right? I go to great lengths over the years, not like I would because I'm a quant, but if I even sniff of any, I'd say, I don't want to hear it. Just stop. Don't want to. Back in the 90s, people get the CEOs drunk and get them to spill some secrets, but that world is largely closed unless you're a politician. which is the most preposterous situation. We ask our Twitter followers all the time, should politicians be able to trade while they're in the office? It's like it's the only Twitter poll I do that's like universal. And they're like, no, of course not. That's crazy. Like how is that possibly allowed? You have social media accounts tracking Nancy Pelosi, and it's on both sides of the aisle. Let's be clear. The current administration is all-time grifters. So how is this still a situation? And do you have any hope this may change? And what would you recommend?
The oldest form of insider trading is not by Wall Street. Wall Street hardly existed in 1792. The oldest form of insider trading is by people in office or in government, in hired government positions, and it still exists today. And it's I think it's a pretty simple explanation as to why it exists, because the people that make the laws are the people that profit. So there's a pretty strong incentive not to outlaw it. I think it's as simple as that.
Someone the other day was talking about term limits, and they were saying, look, we got all these people that are giving speeches today, like they can barely talk. They're kind of like Weekend at Bernie's at this point. And they're like, no one wants this. And they're like, but no one in power is going to vote themselves out of power. So they're like, we should almost do a proposal where it grandfathers it. And I forget who said this. They're like, all current Congress people are exempt, but in the future, you can only serve, X terms or X age or whatever. And I was like, that's a great idea. I feel like the similar situation with, look, if you're in office currently, great, trade away on Robinhood all you want. However, we're sunsetting this or putting it in some sort of, look, you all got to put it in a Vanguard or Betterment account or do something. But it's crazy.
If Congress is going to restrict insiders from trading, which I agree with, they have material non-public information as well, and they should be restricted. It doesn't seem like it's that much of a stretch.
It's funny because so many parts of markets, you can find parallels hundreds of years ago. There was another good quote. This is from the 1830s, talking about real estate, but it just reminds me in general about everyone today. U.S. stock market's been on this face ripper for 15 years, but here's a quote. John M. Morgan, everyone with whom I converse talks of 100% as the lowest return on an investment. No one is known ever to have lost anything by purchase and sale of real estate.
They did in the late 1830s and 1840s.
But that reminds us, it's like a quote like 2007 about real estate.
The quote you're referring to is from David Loray. I forget his actual position. It was some, head of a realtor trade association or something like that. I forget the actual position, but he commented toward the height of the real estate bubble that led to the global financial crisis that there had never been a bubble at a national level in real estate. It had happened in the 1920s, it had happened in the 1830s, it had happened. One of the worst ones was actually in the 1810s. And it's just, people don't look back far enough. And there's a common misperception that we have evolved so much that markets are different than they have been in the past. And the truth that I have seen is that human behavior doesn't change all that rapidly. Maybe 10,000 years it takes to make a real advancement in our ability to manage ourselves. And that's why the same things repeat over and over. And, there's a lot of things that are repeating today.
I'm going to read one more quote, and then I'm going to pause on the quotes. Sorry, they're just so good. But this is John Kenneth Galbraith, where
he's one of my favorites in terms of quotes.
He's like, for practical purposes, the financial memory should be assumed to last at maximum no more than 20 years. This is normally the time it takes for the recollection of one disaster to be erased and for some variant on previous dementia to come forward to capture the financial mind, which is, I thought, just so wonderful.
20 years is probably on the long end. I mean, that's kind of what he was saying. And it's interesting, some of the things, we may talk about it later, that we're seeing in private markets remind me a lot of of some of the shenanigans that we saw in the early 2000s, and people just don't remember.
The benefit of being a student of history like yourself, or we like to pretend we are and talk a lot about it, is, you realize what's happened in the past and how crazy markets have been. And, one example back in 2022, and so many examples over the last 20 years, like the people in power and managing money, often the way they get offside or things go south is it's because it's like a a situation they never lived through. And so 2022, where bonds and stocks both got smacked together, everyone assumed that bonds always diversified. And if you look at the early part of the 20th century, they often didn't. But no one who was around the 1920s is managing money today, et cetera. That's kind of a timeless lesson to look back and say, look, is what's happened before. But one of the biggest topics in the book, and I think is a big topic for everyone today, is this topic of the debt. And then, of course, the Fed. And these two are probably the two big word clouds on what people like to talk about. But, you know, U.S. debt has gone through so many sort of interesting periods. We didn't have any, and then we started to accumulate some, the first banks, and then thinking about how taxes. I got a whole shelf over here. You've probably read all these books. Where is it?
I probably haven't. I probably read a few of them.
Historical, the great tax wars, history of taxation in the United States, real page turners. But anyway, talk to us a little bit about, like, has debt always been something we're worried about? And is it something we should be worried about?
If I have to pick the thing that it's hard to find something unprecedented, but this one actually is. And if I had to emphasize something for listeners, this is not normal in U.S. history. So when Hamilton repaired the debt in 1790 and 1791, he really created two axioms. One was the public credit or the public debt was supposed to be used primarily during public dangers, mainly foreign war. It's a form of protection, right? I mean, wars are expensive and you have to raise funds to pay for them. And the second principle was, after the public danger subsided, you had to be disciplined in terms of paying down that debt as in more benign times. And he tried to get that built into, in 1795, he actually tried to get that second axiom built into law, that you would have to pay down the debt, but it didn't succeed. But for about 150 years, the United States essentially followed that. So in the War of 1812, we ran up debt, then paid it back. During the Civil War, we ran up debt, paid it back. During World War I, ran up debt, paid it back. And then World War II hits, and the Great Depression, we ran up a lot of debt, almost to levels that we're at today. And then after the war ended, we were in this position where we had 70% of the world's gold. We had an industrial infrastructure that was not only intact, but was strengthened because nobody could harm the United States during the war. And we had a lot of just massive bursts of productivity growth. And so we ran roughly balanced budgets, but just the huge economic growth allowed debt to GDP to decline. And we really became intoxicated by our own wealth. And by the 1960s, the rest of the world was starting to catch up. But we just kept layering on more and more and more expenses and violated that Hamiltonian rule of you only run up debt during public dangers. We just started running deficits every year. And it's really continued to today. The debt to GDP levels are now above World War II levels, but they've been accumulated. To some extent, it was crisis with COVID and the GFC. But we've never, for decades, we have not followed that second Hamiltonian axiom of paying down the debt once the public danger subsides. And most people don't realize that. They've only lived during a period where deficits were just normal every year. That is not normal in U.S. history, and most people don't realize that. It's a big problem.
I think it was Buffett. What was his solution that he says, like, if he can solve it by if the Congress people don't balance the budget in any given term, they get booted? That's another good idea. How does it get solved? Like, is it like, because the problem with, these 4-year terms or whatever people are doing, particularly in the presidency, is it just kicks the can down the road? I mean, is it crisis that cause people to be serious? Or are we going to just...
My guess is it's going to be forced upon us at some point. I don't know when that is, but my concern is what prompted Hamilton's program to begin with, which is you need adequate debt capacity when there is some significant costly public danger. And my fear is that our debt we are eroding our debt capacity significantly, so that when there is a crisis, we may just have to deal with it. We won't have the ability to borrow massive amounts of money to deal with the next crisis. My guess is that's how will be solved, because at the end of the day, politicians think short term. The people who elect them think short term. It's easy to blame politicians, but they're getting elected by somebody. And, my guess is we'll keep running up debt until we can't anymore.
Feels to me that the most palatable, to the extent they can control it and not get out of control, is simply to run things hot, meaning inflation, financial repression, where bond yields are lower than inflation rates. That's a tough situation for consumers. It's a tough situation for certain investors. Do you think that's the most likely outcome? Do you think bond yields rip up? Everyone's talking about bond yields coming down, 95% chance the Fed's going to cut rates. And I said, man, I'm looking at these inflation numbers. And I said, I get that's what the consensus is, but that feels a little odd to me.
The only thing I can say with confidence is that these debt levels are not normal. The magical monetary theorists or modern monetary theory, people that say you can run deficits with no consequence, are dangerous, to be honest with you, to be saying things like that. Reserve currencies don't get forfeited often, but they do get forfeited when you treat the public credit irresponsibly. There will be consequences. I don't know what form they will take, when they will come, but I don't think it's as far. This used to be a long-term problem. I would call it a medium-term problem at this point. I don't know, 5 to 20 years.
Yeah. You see, some of this in the UK where bond yields just rip up, where, at some point the markets say enough. You make a fun reference to the reserve currency. Talk to us a little bit about, I think it was in your book, where you talked about there's really only been like 3 main reserve currencies in history, with the Dutch guilder, or the past, I guess, whatever, British pound, US dollar.
Yeah, and this was both crises. They lost it because of crises. So the going back a little, my memory is a little hazy on the Dutch guilder, but it was in the late 1700s when they lost. I believe it was the Fourth Anglo-Dutch War, and that basically bankrupted them. They lost, and the British really took over as the dominant reserve currency at that point. Then World War I and World War II is what knocked the pound sterling out, and the US dollar replaced it. There's no reason to think that the US dollar is going to last forever, regardless of our behavior. Do dominant reserve currencies change often? No, but they do change, and it's usually around a crisis. And I don't know what that crisis will be. Will it be some kind of natural disaster? Will it be a war that somehow we think we're completely immune to? I don't know, but we are creating a situation where we are vulnerable to losing that reserve currency status and not being able to adequately fund a public danger in a way that the United States has never experienced since the Revolutionary War.
I know I said no more quotes, but here's a great one. It said, this is the New York World Telegram, April 1943. The kid who owns the ball is usually the captain and decides when and where the game will be played and who will be on the team. Since the U.S. now owns some 22 billion of the world's reported 28 billion of gold, we think Uncle Sam is going to be the captain of the team, or there will be no game.
That was one of my favorite quotes. When I saw that quote, I forget where I saw it. I think I saw it in a book somewhere and then found the article. But it perfect. What I try to do with these quotes in general is there's a lot of times people take quotes from modern day and try to apply it to the past. What I tried to do is use quotes that really captured the issue, but were time appropriate. And that was a perfect one. It describes exactly why we were able to take control of the Bretton Woods Conference and establish the US dollar as the new reserve currency.
It's hard to talk about US financial history without talking about gold. And gold for many years kind of fell by the wayside. Price returns, tend to be a big determinant of that. And then here we are at 3,500 an ounce. And all of a sudden, everyone's waking back up to gold. But for a long time, US dollar had this link. And then it didn't. And now everyone's interested again. Do you have any thoughts on the role gold's played, on the role it should play or should not, or how even investors think about it in portfolio? Anything?
Yeah, I don't know how you link it again, but that is something that a lot of people are unaware of, is that for most of U.S. history, the currency was tied to gold and silver actually for a long time as well. And the benefit of that is that it prevents you from printing money and debasing the currency. Now, a lot of times during a crisis, the governments in the United States did this. They'll delink temporarily from gold and inflate, but it's really a governor on fiscal recklessness. And the greatest risk of now the disadvantage is that it can prevent you from spending appropriately during the Great Depression to help get the country out of depression. And there's a whole story about how the United States delinked in 1971, but the greatest danger of having a fiat currency is that you don't have that governor on spending. And I think we are starting to see those. Well, we are starting to see those disadvantages.
Bitcoin makes an appearance in the book, but not a whole lot. I mean, I get it kind of is a small part of the overall picture. Do you think that has some overlap with gold or with part of the stresses and solutions, or where do you put that highly opinionated topic?
Thus far, I would have thought Bitcoin would not have survived this long, but 15 years is not a significant amount of time. I look at it as more of a speculative asset than digital gold. But, it is a genuine innovation, and that provided that I don't know the detail of how it works, but provided that it generally is constrained in terms of supply, it's not like we've discovered a new form of gold recently. I mean, there are limits to the periodic table, so it is unique in that regard. If you ask a lot of people in the room why they buy Bitcoin, it's usually because they think it's going to go up in value, or they're scared that everything else is going to go down in value and that's going to preserve its value. That is a scary proposition to me. That sounds more speculative than anything, especially when they say it's going to go up in value. So, I joke with everybody that if I ever buy Bitcoin, sell everything you have, because there's nobody left behind me. I will never buy crypto assets. I don't see the upside. I see a lot of downside. And
well, the nice thing for, investors like yourself that don't invest in something like that, they eventually, potentially, if it gets big enough as far as the companies, they end up in the S&P. So you get it one way or the other, good or bad. Ditto for the same reason we don't all own rail companies today, which was like or canal companies or plastic electronics. Talk to us a little bit about, and you can kind of go wherever you want with this question, the evolution of the investing side, particularly with equities. I think probably 19th century, a lot of bonds, but equities really kind of started to make their presence felt, with probably not a whole lot of listings in the early 19th century to a lot by the end of the 1800s, and then 20th century is obviously a whole different story. Any insight on the evolution of the stock and bond markets last couple hundred years?
there are a couple things about stocks, although I don't think they're the most interesting story right now. I think the most interesting story is alternative asset classes, which are seeing some pretty alarming things happening. But the interesting story about stocks is, as you know from where I work at IFA, I'm a big proponent of passive management versus active management. And one of the reasons is because if you look at the history of the US stock market, it didn't take long before it got to a point of relative efficiency and it became very hard to beat market indexes. There was strong evidence of this as early as the late 1920s and early 1930s in a SEC report that was released in 1939. And the reason active management has stuck around so long is before the securities regulations of 1933 and 1934, it was legal essentially to manipulate markets and to engage in insider trading. After those laws, that was outlawed. So the real moneymakers on Wall Street were manipulating the market in stock pools and engaging in insider trading. Once those laws passed, they couldn't do it anymore. So the only game in town was active management. And that is really why it was embraced, even though the stock pool, the people operating the stock pools and engaging in insider trading knew that, it was really hard to outperform the market even back then. So I think that's an interesting story. But I think a lot of people are catching on to the fact that passive strategies tend to outperform the majority of active managers. But at the end of the day, even if you go with an active manager, they're not charging a huge amount of money relative to they are relative to passive strategies. But what we're seeing now with some of these alternative asset classes that are being introduced to retail investors, these are fees that remind me. I remember writing about the closed-end funds in the 1930s, and they would charge, like a big load of 2.5%, 3.5%, and then an annual fee of 1.5%. All in, it would be like 6 or 7%. Like, you're actually starting to see things to get into private markets that are close to that. And to be honest with you, it's pretty appalling to me to watch it.
We'll get deeper into that. We have in our bathroom, if you ever come see us at Cambria in Manhattan Beach, at the headquarters, we have the classic poster, I believe, from the 1970s, might have been the 1980s, that indexing is un-American, when a bunch of the indexes started to come out. And I posted it to Twitter, and I think a lot of people took it the wrong way that don't know their history. I was laughing and saying, this is going up, this is great, we love this concept. And I think people thought, the Bogleheads tend to get after me for some reason, but they thought I was, dunking on indexing, which I wasn't. The whole point is we like it. Or like the concept, low cost.
Well, yeah, to me, it's figuring out how to minimize your costs and maximize your odds of outperforming everybody else and letting all of the active managers do all the work for you to make the market efficient. That sounds pretty American to me.
Yeah. Well, we could spend the whole episode on this topic. Back in the 1930s, I want to say there was like a handful of these closed-end funds that launched, and there's actually one that still exists today. I think it's now owned by Voya, and the inception is like 1930s, and they just bought a bunch of stocks and then never touch them again. So you have the descendants with equal shares of a bunch of blue chips companies. And it's, of course, creamed, I think, just about every probably active manager over any time period, which I think is just such a wonderful, hilarious situation. But I actually don't know. I'd be curious to know what they charge today, if they've come down with the times or if they're still expensive. But MIT was another one, right?
Yeah, so there's the Massachusetts Investment Trust. I think that's what it's called. It's the oldest fund. It's an open-ended fund, and I believe it was started in 1925, and it's celebrating its 100th year anniversary. But, most funds from back then are not around, so that should tell you something.
Well, most funds, the ICI stat is, and people love to bring this up with us. They're like, Meb, you're a small asset manager. We're worried you're going to close funds. And I'm like, look at some of the big fund companies. They close or have closed. Some of them are like 30 to 50% of their funds. And so they just chuck all the spaghetti and then see what sticks. And that's that. But ICI says over the course of a decade, on average, and we just saw the new Morningstar Mind the Gap come out, so we'll post that in the show note links, but 50% of funds close or get merged. Half.
At the end of the day, it is possible to outperform. It's just that most people can't. And that's for the masses. That's why the best approach is to just use low-cost index funds and stick with an allocation that makes sense for your objectives, and rebalance, and don't try to get cute.
We've kind of hit on this a few times throughout this discussion of kind of Wall Street predators versus not just Main Street, prey, but also institutions too. I feel like get suckered in just as much as anyone else, whether it's the Gilded Age, whether it's the Roaring 20s or Nifty 50s.com. Here we are now, whatever we want to call it. And you alluded to the private. So it feels like we hit a funny bone with you. And if you talk about the people who are kind of the critics of what's going on, there's a handful of different topics they bring up. What parts of it particularly rub you the wrong way?
Well, I mean, it's like anything. When there's a cycle to these alternative asset classes where a legitimate void appears in the market. So there was a need to commercialize a lot of technology in the 1970s. Banks were still scarred from the Great Depression, so that led to venture capital. There, for a variety of reasons, I can't go into all of them. There was a need for buyouts, a heavy need for buyouts in the 80s. But what ends up happening is when you have a tremendous demand from great opportunities for private capital, the early capital providers have a situation where the demand exceeds the supply of capital, so they can get good terms and generate fantastic returns. People see that. Over a couple of decades, the hordes descend, and the returns for most people are bad. And we've seen that happen with venture capital. We've seen that happen with private equity, with like buyouts. Seen that happen with hedge funds. We're now seeing that happen with private credit. And it's a relatively long, although not that long, cycle, but very predictable. And this private markets craze really is a 25-year phenomenon that started in 2000 when David Swensen, the CIO of Yale, published his book, Pioneering Portfolio Management. And people misinterpreted his advice, thinking that, well, all you need to do is allocate to private equity and venture capital and hedge funds, and you're going to get Yale-like returns. And that's when the flood started. And you're at a point now where there is so much capital from institutions that they're kind of tapped out. And now a lot of these private markets funds are targeting retail investors. There was recently an announcement from the Trump administration that an executive order to allow potentially these to go into 401ks and defined contribution plans. And some of the behaviors that I'm seeing with, and others are seeing with these funds that they're creating, that 40 Act funds, so, closed-end mutual funds, essentially, being marketed to retail investors are very disturbing. And we can get into that if you want.
Well, Swensen called them a cancer on some of the, he's like, I think he also said a mutual fund industry is a marketing industry, not a actual asset management industry.
Yeah, there's probably some truth to that.
Yeah, but it's funny on the private side. I don't know why people do, but I'm sure I just get on a list and it's spam, but the marketers will send me stuff, and on occasion we'll get some that are so egregious and so bad. I'll either respond or just be like, bro, like, what are you talking about? But I've tweeted a few of these over the years, and some of them have ended up being total frauds, and people go to jail, but also a lot of people lose their money. But what are kind of the most egregious parts of this? Is it the fees? Is it the lockup? Is it the volatility claims? Is it what?
It's all of the above, but the thing that disturbs me most is what is happening with secondaries. So there are funds out there, I won't name any names, but you can find it pretty easily, that are creating portfolios of giving private markets exposure by buying a lot of secondary interests in, LP interests that people don't want, probably for good reason. And there's this accounting allowance that really is outdated, that was started in 2009, that allows you to purchase a secondary interest in an LP. Let's say you buy it at a 40% discount. And literally the next day you can mark it up to the last reported NAV by the GP. Now, the assumption is that you bought it in a distressed situation and the NAV properly reflects the value. But what if it doesn't? And I would argue that it doesn't, that the people are getting rid of it because the people can't exit these investments, that they're not worth what the NAV says. And what that's doing is it's creating this misperception that these funds are generating these strong returns, but it's only based on a paper gain that there's a good chance it's not real. And the most appalling thing, and this was, I can say the name because it was published by the Wall Street Journal is a company called Hamilton Lane. I don't know how they convinced shareholders to approve this, but somehow they convinced shareholders to approve a change in their compensation structure. Previously, they were only allowed to pay themselves an incentive fee once, let's say you bought an asset at a 40% discount, or on average a 40% discount, and you later realize those gains by selling them at the NAV or higher. Then you could pay yourself an incentive fee, and somehow they convinced the shareholders to change that rule to allow them to pay themselves the incentive fee based just on the paper markup, as if it's been realized already. It's unbelievable, some of the stuff that's going on.
We've said this on the podcast before, but when I hear stories like this, it becomes even more clear to me. We say there's really two types of people, and you can extend this to organizations on Wall Street. I think there's the on one hand, there's the ones that say, look, we want to charge as little as possible, make a great product, deliver to investors, and still keep the lights on. Like, look, asset management is the probably the single best profit margin industry on the planet. It's got like a 30% profit margin. And on the flip side, you have those that are like, what is the maximum we can charge and get away with it? Like, we will do anything under our power. And the crazy thing to me, when I see something like this, if you're good in asset management, the sky's the limit. Like, you don't need to cheat, right? Like, if you are capable and you show up and you do what you're supposed to be doing, you don't need to push the envelope, right? Like why in God's name would you need or feel the temptation to do this? Like, you're already getting paid on the appreciation. The thing with the long arc of bull markets, and this one's been a 15-year kind of romp since 2009, is that, that's a career plus some for a lot of people. A lot of people say, look, I'm 40, 50, 60, 70, whatever. I got 10 years left. I got, I'm not going to be around when this chickens come home to roost. So let's get it while it's good. But anyway, yes, I agree. How the end investors would sign off on this is curious. You just probably aren't paying attention, right?
I posted something today on LinkedIn. It was based on an article in the Wall Street Journal where, part of me just it is breathtaking to watch Wall Street find these little loopholes and to pull little stunts. I mean, it'll be funny in 10 or 20 years once, the people who lost their money are not crying about it anymore. So in order to disguise the fact that, I assume in order to disguise the fact that a lot of these funds are doing these one-day markups, several funds, you have to see the article on their SEC forms that they have to fill out every 6 months, showing their assets, what the asset is in their portfolio, when they purchased it, what the purchase price is, and how they're now valuing it. They literally took out a column that had the cost of the asset matched to the asset, and they footnoted, separated by commas, like 100 different values rather than putting it in the column. I mean, it's like, and people didn't know that for years. It took a couple of years, like, so no one's reading this stuff clearly, and it boggles the mind.
I think the latter is probably a lot of this is people just too lazy, don't care, someone else's problem.
Which is an irony. The funny thing is, people may find this surprising. I am not. I actually think more regulation is dangerous, because one of the risks of having the SEC, under the umbrella of the SEC, is that people feel like that's a sign off, and that reduces the risks of an investment. So right now you have funds that are basically telling you what they're doing in disclosures. It's ridiculous, but nobody's reading it because they just assume that if the SEC's watching, that it's safe. So it sounds strange, but part of the problem may actually be too much regulation because people think it's a sign off.
If people act on their own accord, they buy it, say la vie, right? Like that's your decision. You want to go buy 0-day options, you want to trade microcaps, like you can do that. You can go lose all your money at the casino. I think the challenge, what you were referring to on sort of the private, 401ks and retirements and other places, it gets it's like different kind of next level. Like, should that?
Yeah, no, I don't think this stuff belongs in a 401k. I mean, there's no question.
What do you think about Vanguard offering private equity? Is that slightly less terrible, or is that?
It's slightly less terrible, but it's still terrible, in my opinion. I mean, look, I'm a big Vanguard fan. I think they've done more good than probably every financial firm out there, but I think it's a mistake for them to get into private assets. I think it's the fee. I don't see the risk return trade-off. I mean, people say it's diversification. Well, diversifying is supposed to make your returns better, not worse. And I don't see how this can make your returns better when the fees are so much higher. You got asset classes that are oversaturated with capital. It's not liquid, so you can't rebalance really. Liquidity for those things can dry up really quickly. I mean, they're liquid as long as funds are flowing in. As soon as funds start flowing out, they're not liquid anymore. So yeah, I don't see how this could benefit investors. I think it's a mistake.
You look at some of the listed, not just PE companies, but funds that are listed elsewhere. You used to have a lot of these foreign listed hedge funds that you could see, and they get marked. Now, a lot of them would be closed-end funds, so you got to adjust for sort of NAV, which, because their private assets are already a little bit fictitious. But you also see a handful of replication ideas. And there's a company that launched an ETF. It rhymes with Lacer. But they did a PE/VC ETF that, to target the returns of PE/VC, it's like, here's the characteristics. But that sucker leverages the total notional exposure is like 2.5x. So market goes down 30 or 50, this thing's going to go down like 80 or 90, right? But it's just interesting because that's what they think it takes on the vol side to track the returns of this space, which goes to show that this space isn't a 5 vol or a 10 vol or a 15 vol. It's probably, particularly with VC, a 20 or 30 or more. So the downdraft, just because it hasn't happened.
Yeah, it's an illusion because they don't mark. They don't market to market the way, I mean, daily, and these NAVs, I mean, look, it's hard to say a generalization without actually seeing their models, but I just can't imagine these NAVs are really reflective in a lot of cases with the value of the assets, the real value of the assets.
Let's bounce around a little bit. You got a lot. Listeners, go get the book. It's a lot of fun. I'm not going to sit here and make Mark go through all the great parts of the book, but any favorite stories come out or ideas, chapters in history that you learned that you got on your wall behind you, where kind of as you did the research, you're like, oh, that's interesting. That's a particularly fun or weird story that I'd never heard before. Anything on your mind?
I think the two most interesting characters were Alexander Hamilton. He was a true genius. The number of things that he foresaw. I just posted something on LinkedIn the other day, a quote from his 1795 speech on how politicians were likely to abuse the debt in the future. And it just sounded exactly like what's happening today. His ability to predict the future was unbelievable. And then the second character is Hetty Green, who I always tell people that the most impressive, I think she was the best investor in U.S. financial history, was a woman. Her name was Hetty Green. She came from the whaling industry, so she had a very different mentality of investing. It was much more long-term, much more disciplined. She was very thrifty, and she was completely misunderstood. And I've written a couple articles on her, and then the last article was written by a former student at Fordham, Bethany Bankston, and she found her will. I'm sorry, the will of her daughter, which passed on her fortune. And she's just an amazing story. I think she's the best investor. She was actually one of the original investors in Hathaway Manufacturing, which became Berkshire Hathaway, which was kind of an interesting aside in one of the articles. So those two characters were the most interesting.
Definitely had some good Hetty Green quotes in here.
She was funny too.
She's a character. A really, really funny character. I don't actually know that much about her. I know the name.
She was the original value investor, I would argue. Very disciplined. Just always seemed to sense, like when the panic of 1907 hit, she had been building up cash for uh, at least a year in advance because she felt it was coming.
As you study history, you start to say, all right, well, these seem like good ideas. These don't. We were talking about 401ks. We used to have a situation in the US where retirement, you have Social Security, but then retirement was a lot of defined benefit. And now it's almost entirely all kind of on your own, defined contribution, 401ks. I saw the first funded pension plan. You had the US Navy in 1800. Any thoughts in general on the state of retirement? Is it in good shape? Should we be doing some things differently? Is there a better structure? What do you think?
I mean, that's a big question. At a very high level, I'd be more in favor of defined contribution plans than defined benefit plans. Because if you look at the states and how those are managed, I think we have some big problems. But on the flip side, people tend not to save enough. And so that's a challenge. So there's so many questions within that, but generally I favor the defined contribution strategy. I just think people need to be very focused. Plan sponsors need to be very focused. They need to focus more on what investments are in the plan and just getting people in the plan and contributing as much as possible.
For someone who, spent a long time on this book, what are any off the top of your head? Are there any particular books that stuck out, either recent or during your research, that you thought were particularly wonderful, interesting, different? Could be famous ones.
I think some of the more relevant books now, number one would be I don't remember the exact name. I think it's called The Great Inflation, I believe is the title, but it's about the Great Inflation. So if you look up Great Inflation in Samuelson, you'll find it. That's a very important book to read because it explains. I am actually pretty concerned about what's going on with inflation right now. I don't necessarily think we're going into the 70s, but the way the 1970s happened was the Fed, there was a lot of political pressure, first from LBJ and then Nixon. And the Fed didn't finish the job with inflation. And every time they backed off, it popped up at a higher level. And I worry that it looks like we're about to do that again. We already did it. I mean, I've been arguing for the past year that the Fed should not have pivoted in August of 2024. And now it looks like they're going to take the foot off the brake again with headline running at 2.7, core running at 3.1. I think it's a mistake. So anyway, reading that book, The Great Inflation, I think it would help people appreciate that I think we got a real problem here, and I think people are underestimating it.
We used to say that, like, the only job you go to Fed school, there's not a Fed school, but like the point, like you go through academia, you're like a professor, like you're like one thing you learn is the PTSD. Like there's two topics you really study. One's the Great Depression and one's the 1970s. And you're like, how do we not do that again? In the 70s, like you mentioned, was like you had this initial inflation pulse, and then they're like, all right, we're good. We're good. We're going to chill. And then it went crazy. And so the interesting part is, like, it's very clear, it seems to me, that Powell at least gets that, right? Like a little bit. But the problem comes when you very clearly, this administration is hell-bent on lowering rates. You put someone in next year, or God forbid, sooner than that, and all of a sudden it creates the sort of dynamic which we're kind of referring to, which is like we're at 3%. And I don't know.
Yeah, and every time you fail to contain it, it rises to a higher level and it becomes harder and harder because you're going to have to force a harder recession. I mean, the recession in 1981 and in 1982, which was the result of Volcker raising rates all the way to 20% at one point, it gets harder and harder, which is why people thought I was crazy in August last year when I was saying, like, this is a big mistake. You almost have to cause a recession and go below that 2%. So it pops back, when you start lowering rates again, it kind of pops back up to that 2%. They think that you can come down to, around high twos, low threes, ease off, and it's going to go back down. There's a good chance it won't. It'll pop back up, and then the next round it gets harder and harder. It gets built into people's expectations, and I think people are underestimating it.
We'll see. You can now bet on this, on the prediction markets, on if and when the Fed is going to cut, if and when Jerome Powell is going to get sued or get replaced. Who's the replacement going to be? It's all one big betting casino now. But at least for now, it seems like he may make it through the year. We'll see what he does in September. Who knows?
Yeah, well, I think they're going to cut at the next meeting.
That's the consensus, like 95%, I think. So what's been your most memorable investment? Do you have something that comes to mind? Good, bad, in between?
All right, I'm going to go a little off on this one, but there's a quote from Charlie Munger. It goes something like, there's no better predictor of the future than financial history. You can... there are billion-dollar ideas buried in a $30 book. And I think about right when COVID hit, and I was just completely caught off guard, and I was actually looking at it earlier this week. This was the first book I read, was the Big Board by Robert Sobel. And it's a recap. I think it was published in around 1970 or 1980, so it doesn't go all the way to today, but it was a history of the New York Stock Exchange. And that's what really got me into financial history. And not only, I hope this book is helpful to listeners and everybody that reads it, but it's also helpful to me. It took me on a new trajectory career-wise. It created a new income stream in and of itself. Is the best investment I ever made was buying. Probably cost $30, just like Charlie Munger said. And it's been the best investment I made.
Have you gotten the chance to visit? Have you been to the NYC?
I never have, believe it or not. And I am so jealous because my wife works for a public company, and she got to, it actually wasn't at the NICE, it was at the NASDAQ, but she got to ring the opening bell once, and I've never even been in the facility, which...
Well, I'll make you a deal. Next time we go to ring the bell, we keep launching funds, so we're bound to do it. We'll bring you along. Mark, where's the best place to find you? Where are most of your writings sit today? LinkedIn? Whereabouts?
So I post pretty regularly on LinkedIn. Usually 2 or 3 times a year, there's a quarterly publication that is Financial History by the Museum of American Finance. I publish there. The CFA Enterprising Investor published probably 4 or 5 articles there. There's Wall Street Journal is doing a big 250-year anniversary series. I'll have an article there in a couple weeks. But yeah, track me on LinkedIn and get the book if you. I hope it would add value. It's added a lot of value to my life, and I hope some of it can transfer to your brain if you have the time to read it.
We'll put the link in the show notes, listeners. I have a suggestion and a request for you. Next time you're chatting with the people, so listeners, you've probably never heard of the Museum of Financial History. They put out this amazing, is it monthly or quarterly?
It's quarterly.
This quarterly digital magazine, and you got to tell them, say, look, you got to come up with some sort of option to print this sucker out, because I hate reading anything digitally. And like, there's some number, it makes sense to them where they're like, look, you can subscribe to this. It's $100 a year, $200 a year.
I'll relay that to them. I'm on the editorial board, so I'll relay that.
The stories are so awesome, but I can't bring myself to read a long financial history magazine on the computer. It's tough. Anyway, we'll put a link to the show notes because it's got all the archives, which are also
yeah, it's great. It's a fantastic, that museum is fantastic. The publication is fantastic, and it's a real rarity, and I think it's very important.
Where is the actual museum? Is it in New York City?
They're opening a new facility. It's actually in Boston at Fidelity's, because Fidelity is providing space, and it's going to be amazing. I've been asked to be a guest. It's called a guest curator. And so I'm working with Richard Silla, who's a very well-known economic historian, and the museum team to design some of the exhibits. It's going to be absolutely amazing.
Awesome. That's exciting. Mark, it's been a blast. Thanks so much for joining us today.
All right. Thank you, Meb.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.